Welcome to Adding Value with Assar, the show where we dive into the stories, strategies, and market insights shaping the world of industrial and logistics real estate. In each episode, we sit down with industry leaders, investors, developers, and tenants to explore their journeys, unpack current market trends, and share takeaways that can help you better understand and navigate the business. You guys can work through this, right? Like you can
screw up all you want. You can screw up all you want. You're doing real well on this to start. So I see things being positive going in.
Well, it means good news for all of us.
I hope so.
Yeah.
If not, you can roll back the tape and yell.
Yeah, that's right.
I would say a common trait and something for young people or new people in the industry to think about for successful brokers is the ability to listen.
Value creation is not just about the numbers and the financial stuff. It's about creating value for our customer.
I remind myself, like, this is the business we got into. This is what we got into.
Yeah.
The prerequisite was that you just don't give up.
We having the Kelsey brothers on next time?
Maybe. Who knows? A quick note for our listeners. If you're an owner, asset manager, or leasing manager with a 100,000 plus square foot building in vacancy coming up in the next 18 months, I'd love to talk. A lot of assets in this market have been represented by the same legacy brokers for years. Sometimes that works, and sometimes it doesn't. If you're ready for a fresh, aggressive approach to reposition and market your property, please contact us. I'm Assar with Voight Real Estate Services, and let's add value to your portfolio. Today, I'm joined by Chelsea Levane, Director of Investments at Cabot Properties. Chelsea is based in Cabot's Orange County office, where she's responsible for sourcing and closing industrial real estate investments across the Western U.S. Cabot Properties, founded in 1986, is a global private equity real estate firm focused exclusively on logistics and industrial assets, with a significant portfolio spanning the U.S., Europe, and Australia. Cabot invests in both as owner-operator and in development deals across the Inland Empire. We'll be talking about Cabot's investment approach, how institutional capital views the market today, and what's driving opportunities across the Western region. Welcome to the show. Well, Chelsea, thank you for coming today. It's a pleasure to have you on the show. For folks that may not know about you and your background and the background of Cabot Properties, can you just tell us a little bit about that?
Yeah, of course. So Chelsea Levane, I'm a director of investments at Cabot Properties. I've been working at Cabot for a little over 11 years. Actually started as an intern at Cabot 12 years ago. Cabot, for those who don't know, is we're a global private equity company focused on industrial real estate. So owner-operator, developer of industrial real estate across the globe, really. I sit in our Irvine office in Southern California, responsible for acquisition activity on the West Coast.
Okay. And you guys are headquartered in Boston, right?
Yep, headquartered in Boston.
And you're originally from Boston?
I'm originally from New York, but went to college in Boston and had been there for, 11 years, 12 years before moving out here in 2021.
Did you get started in that location in Boston?
Yep.
Very cool.
Yep. So started as an intern at Cabot's headquarters in Boston when I was still in college, and then moved that into a analyst role on our asset management team. And then after a couple of years in asset management, I had sort of had my eye on the investment side for a little bit and was able to move over onto the investment side, started working on our core strategies and our separate accounts, and then kind of pivoted that into a more overall investment holistic type role. And so before I moved out here in 2021 to open the office out here, I was covering the Southeast for us for a little while. So seen a bunch of different markets across the country, but for the last 4+ years, been focused solely on Southern California.
4 years in Southern California.
Yep.
I think we might have talked about this before, and I can't remember because I went to school for a year in Boston.
Yeah.
I went to a small school, it was called Babson.
Yeah.
And I do remember having a classmate when I was in the program who in undergrad also went to Bentley.
Yeah.
And Bentley was known, I think it's in that same little area, and Bentley was known as the more kind of analytical school where finance majors and accountants go to.
Yeah.
You went to Bentley, right?
Yeah, I went to Bentley. Where Bentley and Babson are the Boston suburb niche rivals in the business sector.
Yeah, it's actually really funny. It's about 30 minutes out of the city. It was a good experience, though.
Yeah.
I really enjoyed it.
Yeah, it's both schools are awesome. I think at Cabot we've got a bunch of people from Bentley. We probably have a few from Babson. I can think of one we have from Babson right now, but the colleges surrounding the Boston area have been an awesome pipeline for us
sure.
on talent.
There's so many schools out there.
Yeah.
So you've kind of seen the perspective you said in the Southeast. Now you're covering the West Coast. From your perspective, what kind of makes Cabot's investment philosophy a little bit different than maybe some of their competitors out there?
Yeah. I mean, I think one of the things about Cabot that is so unique is the time that we've been focused on industrial. So Cabot has been industrial only since our company was formed in 1986. In 1986, really through the early 2010s, industrial wasn't all that institutional.
It wasn't that sexy.
It was sort of a very small piece of the institutional real estate market. And then obviously with Amazon and the takeoff of e-commerce, it's become very institutional. And so I think that our track record and our history in the sector, kind of prior to it becoming as desired as it is now, really gives us a leg up on understanding industrial more holistically, kind of historically how it's performed, how e-commerce has changed the asset class, and sort of where we think things are going.
And when it comes to, given that you've had multi-market exposure, how would you say the Inland Empire differs than many of the other industrial markets across the world?
Yeah. I mean, I guess pre-2021, 2022, it was, and even I guess in that time frame, it was this market is so obviously driven by the population. 25 million people in Southern California. That's a lot of consumption. The ports obviously are a huge piece of the equation in this market. I think what makes Southern California unique today and the Inland Empire unique today is that the 2021 and 2022 run up in rents has created this sort of dynamic where rents are falling and the market has fallen out of favor for a lot of companies. And so it presents this really unique opportunity.
Buying opportunity.
To buy and to sort of be consistent in the market with tenants, that I think gives us a sort of unique position.
Sure. No, I think you bring up a great point because, and we've talked about it quite a bit on this show, is when you look at where buildings are selling today, and the values that they're selling for today, they're very near or below replacement costs.
Yep.
And to own an institutional caliber quality asset and pay below replacement costs in California, where you have so many challenges with entitlement risk and barriers to entry. And
the yield premiums on top of that we're seeing in this market relative to other markets across the country, because no other market across the country has had the rent decline in the way we have. And so you're sort of solving to your yield on market based off of a lower rent than what's in place. And so you're able to get this really strong yield
premium
profile on a lot of these deals, that for us has been an interesting way to kind of carry through the softness in the market right now.
A quick note for our listeners. If you're an owner, asset manager, or leasing manager with 100,000 plus square foot building in vacancy coming up in the next 18 months, I'd love to talk. A lot of assets in this market have been represented by the same legacy brokers for years. Sometimes that works, and sometimes it doesn't. If you're ready for a fresh, aggressive approach to reposition and market your property, please contact us. I'm Assar with Voigt Real Estate Services, and let's add value to your portfolio. So you're essentially saying that the opportunities that are being presented to purchase in the Inland Empire are giving a healthier yield than you can get in a different market, in any market.
Yeah.
Because the rents that are in place may be considered over market rents.
Yep.
Got it.
Yeah. I mean, we've bought deals north of a 7 cap here. We've seen deals trade, in the 8s. The across the rest of the country, everyone's still sort of solving for that plus or minus 5.25 to 5.5 yield. And maybe if you're in some secondary markets, you get a bit of a premium on that. But to have, 200 basis points of spread on that because of this dynamic with softening market conditions and softer rents, I think we view as a great opportunity to take advantage of the softness and also capitalize on these above market rents and
Sure.
cash flow
for the
for our
3, 4,
funds.
5 years or whatever the rents that are in place.
Yeah. I mean, in a lot of parts of the country and even here historically before, rents kind of corrected or came down, a mark-to-market opportunity was you were buying something, in the 2 or 3 cap range, expecting it to pop to,
A 5 or
5 or
6.
6.
Yeah.
And now we're buying stuff in the 7s, expecting it to correct down to 5. I'd much rather make that bet and outperform on the back
100%.
end than take the risk on the 2 or the 3.
That makes a lot of sense. So what do you think what would be the hesitation? I mean, if it makes a lot of sense to me and obviously makes sense to you guys from groups that may be sitting on the sidelines, what do you think the hesitation may be from them?
Yeah. I mean, I think that there's obviously the question mark about how long it takes for this market to correct and how long it takes for rents to start going back up. I think that that's something that is difficult to time.
Mm-hmm.
Timing the bottom is really difficult. I think, we see and have seen a lot of data that tells us that the market is sort of at its bottom and we should be on the way back
Bullish.
up. I don't know. I guess it's hard to say how long it takes to get back to growing rents. I think obviously Liberation Day kind of threw a wrench in that, right as it felt like everyone was sort of gaining some confidence in where the economy was and where it was going long term. That kind of slowed tenants down on making decisions. And the longer it takes tenants to make decisions, the longer it takes for the market to correct.
For sure. And you're 100% right. I mean, I remember working on several potential assignments, right? Because our deal cycles are so long that, a potential assignment can take, there might be 6 months leading to when the actual assignment is coming to fruition.
Yeah.
And at the beginning of this year, leading up to Liberation Day, I felt very optimistic about a lot of tenant representation assignments. And not to say that there haven't been some since, but a lot of those requirements got put on hold. Now, what I have been noticing in the last couple weeks is now that 1 or 2 quarters have gone by, a little bit of that fear of taking on expansion space or making that next move has kind of dissipated, especially from the companies who've been able to weather the storm. We were in a meeting last week where a user, a fairly large size user, was essentially alluding to that they felt like the American economy was resilient enough that they could kind of now make the decision on what their next step is going to be, which was going to be further expansion. Having said that, I know that there's this conversation about more tariffs coming in November, which again throws a little bit of a wrench into the picture.
Well, we've got like 6 days left until we get new tariffs.
So on the topic of deal strategy, what kind of deals are you guys looking to invest in today?
So our primary buckets of capital are our core fund and our value add fund. And so those strategies are different. I think we've been active with both in the last few years in this market. We've been very active with both across the globe, really. Our core fund is US focused. Our value add fund is more global, and so we do a lot in Europe, and we've made some investments in Australia in that fund. And so the focus, I think, on those funds are different. Core is lower risk, lower returns, buying the best real estate with the best tenants, and value add is really finding ways to take an investment and improve it. Our value add strategy, I think, is really to take something that has a value add component in a way that we can exit as a core opportunity. And so we're not really going as far down the value risk spectrum as some other groups. We don't really want to be buying Class B. We don't really want to be buying non-functional product. We want to have core real estate that has some value creation component to it that allows us to take an opportunity and turn it from value add into core.
So for folks who may not know the difference between the two sectors, a core profile is a deal that is essentially like a Class A building, a newly developed building,
Yep.
has a credit tenant in place with plus or minus market rents.
Yep.
And so you have a bucket of capital where it's seeking deals of that profile.
Yep.
How long is the hold for a core asset? Are you guys holding for 5 years, 10 years? Does the fund close at some point and you sell everything in a portfolio?
Yeah.
What does that look like?
Yeah, so our core strategy is a 10-year hold. We have had portfolio exits on both our value funds and our core funds. I think that's not really the market right now. The portfolio buyer is effectively on the sidelines at the moment. And so I think that it doesn't really change our strategy in the way we invest, but it maybe changes the way we think about exit. And so we want to, number one, we're investing in real estate that, if liquidity in the future becomes a problem, it's stuff that we want to own forever. And stuff that we feel good about owning forever. And then I think, number two is really portfolio composition. So if you can't sell an entire portfolio, how does a subsector of that portfolio make sense on exit? And so
by itself.
Yeah. So, when you really look at even just things we buy in Southern California, how do those blend together?
Okay.
In addition to how it blends together with the national portfolio.
Is it fair to say you guys, when you say blend together, when you're buying assets, for example, in the Inland Empire, that you're looking to have a diversified pool of assets that you can sell together?
Yeah.
Is that a fair statement?
Yeah, absolutely. I think you want the quality to sort of work together. So you don't want to have, something that was built in 2023 with something that was built in 1970.
Sure.
Like, those assets are very different. The buyers for those assets are typically different. And the cap rates assigned to those assets are typically very different. And so you want assets that work well together, that the same buyer wants to buy, more than one of. And then you want some diversification in terms of location, tenant, lease rollover, rents, anything.
Sure.
And so that's sort of how we think about portfolio construction. Size range, right? You don't want to buy 5 buildings that are all 200,000 square feet that all appeal to the same tenant base and all roll in the same year, because then you're just competing against yourself for
Sure.
a limited pool of tenants.
And when you talked about the value add strategy, you made a comment about how the profile would be to get to a core asset.
Yeah.
What would be an example of that? Would that be just buying a great building in a great location, Class A, but maybe just has under market rents in place, and then in 3 years or 4 years, you guys market to market, and now it's considered a core asset? Is that kind of typically what you're looking for?
Yeah, that's definitely part of it. I think recently here we've bought stuff with above market rents and near-term roll, and I think the near-term roll scares a lot of groups because of this softness we're feeling in the market. And we've sort of been able to underwrite appropriately to account for that risk, I think.
Mm-hmm.
A lot of what we do in our value add fund historically has been development. That's something that's a little bit more challenging right now, just given vacancy levels, where rents have fallen to, general market dynamics that make finding land really difficult.
Right.
Municipal challenges. There's a lot of reasons development's difficult right now, which is, another piece of us feeling that buying existing real estate, especially existing core real estate right now, is
really where the opportunities are at.
Yeah, it's a great strategy.
On the topic of development, you mentioned historically you guys have served as capital for a number of merchant builders out there.
Yep.
But moving forward, you guys are looking to essentially be vertically integrated.
Yeah.
And looking to essentially do your own development deals.
Yeah.
Can you tell us a little bit more about that?
Yeah. So a little over a year ago, we hired some development professionals across the country. Adam Schmid, we hired out here. He's an awesome guy. He's
he used to be at Brookfield and was at Duke before that, right?
That's right. So he has a ton of development experience, both those shops. He knows this market and all the West Coast markets really inside and out in terms of entitlements, the vendors and the contractors you need to work with to get deals sort of from the beginning through the finish line. He understands the risks in each pocket and submarket. And so he's been an awesome resource for us, both when we look at land opportunities and when we're looking at existing buildings, on really understanding, the underlying fundamentals, and potential municipal challenges within each market. We also have hired somebody in Texas and Chicago. And so nationally, we really are focusing on bringing more of our development deals in-house. We've had great partners in the past that, we've done some great projects with, and we will continue to partner, with some of those existing relationships for the right deals. But for us, I think growing our platform and being able to do more of that in-house is a benefit to us. It's a benefit
Absolutely.
to our investors. It gives us another level of control over our projects that I think is critical going forward.
And you guys already have a stellar reputation, have the capital, and I'm assuming by bringing it in-house, it's going to yield more returns to your investors as well.
Yeah, exactly.
On the topic of, and knowing that you guys are obviously moving forward to be kind of vertically integrated in the development side, just so folks can understand, because, we've done so many different land deals, and it's always very interesting because when you come across a landowner, a lot of times, if they get multiple offers and they're reputable developers, and a lot of these offers state that they're cash offers, right? And a lot of times the private landowner may not be able to differentiate one group from another, and may not be able to really differentiate whether they're self-funded or if it's a JV structure where they need to raise capital. And a lot of these times, the developers are JVing with capital partners out there. In your experience in the past, when these groups have come to you guys and looked to partner on deals, what have those structures look like? Just kind of taking a layer of the onion back and understanding what that is.
Yeah. I mean, there are a lot of groups out there that do true joint venture deals. That historically hasn't been our preferred structure. So a lot of what we have done historically, we call a synthetic JV. And so there's a fee for the developer, there's upside on the back end for the developer, but they don't have any true ownership over the land and the development.
Got it.
And for us, that gives us
Control.
a better layer of control, easier execution on exit if the opportunity presents itself. And so we view that as a way that we can better manage the exit for
sure.
our investors, to make sure that we're not, tied up in a JV that makes it difficult to sell at the right time.
So in theory, developer comes, they build a relationship with a couple brokers, and the brokers find them a land opportunity, a private owner who wants to sell a site. They make a deal with the landowner, and they get a period of time to do their due diligence and maybe even secure entitlements. And they have a contract price. And then they, when it comes time to fund the deal, they align themselves with a capital partner who comes in. There might be a scenario, correct me if I'm wrong, might be a scenario where the valuation of the land maybe has increased due to market conditions. Maybe has increased due to entitlements that have been secured. And it's higher than the contract price in place. And so there's an opportunity for the developer at that time to make a premium when they bring in a capital partner. And then to what you were speaking to earlier, they earn fees in the development of the project. And when the development is ultimately built, leased, and sold, the developer is able to have a percentage point of the profits, which is just called a promote.
Some sort of success fee based on, ours are typically based on, leasing and value creation. And so to your point about the land lift at the beginning, right? Like, in some scenarios, we'll pay out a land lift. It ultimately hurts the value creation on the back end, right?
Correct.
Because the basis is higher. And so it's a negotiating point, a decision point for the developers as well of, do I lock in some profit today that's going to hurt my promote on the back end, or do I, sort of see this project through and hope to make more promote on the back end. And so it's sort of a risk-adjusted
decision.
return, and each developer kind of has a different view on it. And I think the market dictates that at some points. And, we're typically open to either. But I think that generally your alignment with a partner is a lot better if they're focused on the success of the project at the end rather
Absolutely.
than taking the cut up front.
You both have invested interest in the success of the project at the end. It's they're squeezing the juice out on the front end.
Yeah, exactly.
Yeah. Do you also oversee kind of leasing assignments of the assets that Cabot owns in the Inland Empire?
So we have a great asset management team that sits in our office out here as well. So Stephanie Wilson runs our asset management. She came on board to Cabot when I moved out here in 2021. We opened the office together. She was at AEW before that, and so she really oversees the leasing and the tenant side of the business. I definitely take interest in all of it
for sure,
because it obviously informs what I'm doing and understanding the current dynamics in the market. But she really runs with that.
What are you hearing right now from Stephanie?
Oh,
what is the good word out there?
The good word. The good word is we've been fortunate enough to be pretty well leased through a lot of the softness in this market. We've got one vacancy in the Inland Empire right now that we're, I believe, out to leases on. And the real role in our portfolio out here doesn't come until 2027 and 2028. And so it gives us this ability to understand where the market is today, see the tenants in the market, and then really believe in this thesis of the market improving in the next year.
For sure.
And we hear that from leasing brokers all the time. You're seeing that with your tenant clients. We hear that from a lot of different groups. I think we heard that from a lot of different brokers in 2024.
But there was some truth to it. There was some truth to it because the leasing activity did pick up in the beginning of 2025. And even though President Trump was running on the tariff idea, I think none of us really believed that until it actually happened.
Yeah. Or the scale of it, right?
Yeah.
I think there was, I remember, pre-Liberation Day, there was a point where we were hearing from brokers like tenants are at leases ready to sign, but they have told the landlord that the tariff percentage will impact how much they're willing to pay in rent. So if tariffs are, 20%, like they want some discount in rent that makes up for that impact to their business. And landlords were generally okay with that. And then tariffs go, 130% or whatever it was. And it was like, well, nobody was really expecting that.
Right.
It's hard to retrade rent on that.
I don't know if we can give a discount for that one.
Yeah.
No, that one. So.
So I think that, it's been volatile, which, to your point, in 2024 and the beginning of 2025 led to a lot of front loading of demand. And we've seen that slow down, I think, in Q2 and Q3, but it does feel like we're getting back to this place of comfort in the discomfort from corporations, that they're closer to being able to make decisions and get off the sidelines.
So on the topic of deals, you guys recently closed a deal in July.
Yeah.
Can you tell us a little bit about that deal?
Yeah. So that was a deal for our core fund. It fits the profile of what we've been talking about with this above market rent dynamic. And
how big of a building?
So 350,000 square feet.
It's in Perris, right?
In Perris.
Brand new building.
Brand new building, fully leased to a credit tenant. They signed a 5-year lease in 2023. So just under 4 years left when we closed on it.
So in 2023, in theory, the rents were higher than where market's at today.
Yeah.
Exactly what you were talking about.
Yep. Higher than where rents are today. And so we're able to get a premium yield on that, and we're able to get it in an incredible building, excellent credit.
What is the ingoing yield?
Going in yield of a 5.9.
Okay, just under 6.
Yep, 4% escalations on the lease. So we're getting, I think we're getting the high 6s before roll, and then we are underwriting rolling down to a 5.
And that underwriting assumes that rents stay stable, or is there rent growth back in there as well?
We model some rent growth in there.
Okay.
Yeah. And we think, so the lease rolls in 2029, I think, we feel the trends in the market with lack of new development starts and the tenant activity that we've seen, we feel that
confident that 2029 is going to be a better
be
place.
a much better place than we're in
I would
today.
hope so. And I feel the same way, but I would hope so that in 2029, rents should be, I don't want to say substantially higher, but they should be higher.
Yeah.
And when you're looking at deals, let's say in the Inland Empire across the full Western region, what would you say, other than the yield profiles being higher in the Inland Empire, are there any different dynamics that you're seeing versus, for example, Phoenix or other core markets?
Yeah. I mean, I think Phoenix is such an interesting one for us because there has been so much construction there, rivaling the amount of construction in the Inland Empire for a much smaller market. And the rents have just continued to grow and the tenant demand has continued to be there. And so Phoenix continues to perform really well. I think that oftentimes when we look at opportunities in the Inland Empire, we think about how they compare to other markets across the U.S. And Phoenix is one where, Phoenix and Las Vegas during the run up when the Inland Empire was sub 1% vacant, they got the benefit of tenants not being able to find space here. So a tenant who needed a West Coast distribution hub was expanding their search beyond the Inland Empire to Phoenix or Vegas. And those markets saw a lot of demand. When more buildings came available in the Inland Empire and there was more availability to lease space here, we still saw a lot of demand going to Phoenix.
Interesting.
And so I think that it is a maturation of supply chains. I think that there are tenants that will forever need to be in Southern California. It doesn't make sense to get stuff off the port, from the ports, from Asia in LA, Long Beach, bring it to Phoenix, only to bring it back to California to sell it to the 25 million consumers that live here. I think there's going to forever be demand for industrial space in Southern California. But if you are somebody that, imports from the ports of LA and Long Beach, and then from there you're distributing to the whole country, having something in Phoenix as your first stop and then going out to the rest of the country does make sense.
What's the rent difference today?
And it's cheaper, yeah. I think it's tightening. It's definitely tightening. Rents in Phoenix continue to go up.
Empire.
Rents here continue to go down. And so that spread is really tight. I think when we look at an opportunity like this core deal we bought, one of the deals that jumped out at me was a deal that sold in Phoenix as this is the best comp for our building right now because there haven't been very many trades in the Inland Empire. If we're buying something at a lower basis and a higher yield than where a similar profile deal in Phoenix is trading, I feel a lot better being in the Inland Empire long term.
Agreed. Agreed. Yeah. I mean, I don't know a whole lot about the Phoenix market, but just on a high level, on a macro level, that all makes sense.
Yeah.
On that topic, what is the basis on the deal you bought in the Inland Empire?
$260 a foot.
Got it. And where do you think that stacks up around compared to replacement costs?
It's hard to say. I mean, we have this conversation a lot. Since Adam joined over a year ago, we've spent a lot of time looking at land. There's not land out there to be had, really. There are, so peak land trades in that pocket of the Inland Empire were in the 70s per land foot.
Remember that, yeah.
Which
those are good old days.
Yeah, the good old days.
Yeah.
That translates to, God, what'd you say, low to mid 300s square foot.
Under the roof.
Yeah, once you've built the building. And so relative to peak for certain, you are at a discount to replacement cost. There are a lot less willing land sellers today.
Right.
Because land values have fallen. Construction costs have gone up. Financing costs have gone up. Your ability to build in a lot of these locations has been limited by AB 98 and other legislation that makes developing industrial buildings more difficult. Cities are cracking down on truck routes and tenancy and all kinds of different things. And so it is getting harder and harder to build. It is getting more and more expensive to build. And the price land needs to be, there are no willing sellers at where the price of land needs to be to make deals pencil today.
Sure.
The only real comps we have seen on the land side have been user sales.
Absolutely. Which some people speak to those as indicators that the market is turning.
Yeah.
Right. And there've been some healthy numbers out there that users have purchased land sites. And to a couple other brokers I've spoken to that have been through multiple cycles.
Yeah.
They've pointed at those comps and said, hey, this is an indication of good things to come.
Yeah. Yeah. I mean, we negotiated a deal recently with a tenant, an early renewal for a space that they occupy that rolls in 2027. And we got, I can't share the specifics, but we got a rent that is much higher than where the market is today. And they are a very sophisticated operator in the market. They're an international operator. Their view of where they think the market will be in 2027 is a much better place than where anyone I talk to on our side of the business thinks the market is going to be. And so I think to your point, like, we keep understanding what the tenants are thinking about where this market is going, I think is critical to informing, where we think the market is going to go.
So it sounds like you're an optimist. You're a believer that the next year or two, which feels like we are as well, the market's going to be getting better.
Yeah.
For folks out there who are thinking to themselves how we can potentially work with a company like Cabot Properties, whether they be brokers, what is some advice that maybe you can give them on how to be a better broker and also be able to come into touch with you and put a deal together?
Yeah. I mean, I think it's tough out there for brokers. For every optimistic day I have, I probably have a pessimistic day as well. I'd say maybe it's, 3 optimistic days, 2 pessimistic a week. And it definitely varies depending on the information you're getting, the comps you're seeing, the people you're talking to. And there's a lot of reasons to be optimistic, but there's still a lot of softness in the market, and there's still a lot of deals getting done at pretty ugly rates. And so there's really 2 sides of the equation. So I think brokers that come at it from the optimistic side and can really tell the story of where the market is going and why a certain building or size profile or deal profile
makes it unique
and has a path to success, I think is important. I think that, we've tried to spend as much time as we can on land. I think it's been interesting. A lot of groups that had historically spent, a lot of brokers who had historically spent a lot of time on land aren't spending time on land right now because those opportunities aren't really there. And so, from our side, understanding when that comes back and being positioned with all of those brokers that when it comes back, we're kind of first in line to jump at those opportunities.
For sure. No, and I get it. I think for as much as a broker may like to work on land assignments, I think one of the challenges is, if there's no demand because there's existing inventory on buildings, and there's no demand to necessarily buy land and build, then essentially you're not going to be able to do a deal.
Yeah.
And as a broker, there is a level of where, similar to as an investor or a developer, you have to be an opportunist. The market is swinging a certain way. You have to be able to identify where the market is trending to and position yourself to either have some expertise or to be able to do some transactions in that sector. So it makes sense. I think a lot of folks in our business are doing tenant representation assignments, buyer representation assignments, because the leverage has shifted a little bit onto that side of the equation.
Yeah.
And it's essentially a way to stay relevant and do deals.
And the brokers that are doing the tenant rep assignments are the ones that really understand where tenants are and where they see the
For
market.
sure.
And I think that is, on our side, that's critical, right? If you're hearing from 10 of your clients like, oh, I'm done with California, I'm going to Phoenix, which is something that sort of, pops up at times in the cycle, that information is critical to understand that, the demand may not be there as quickly as we think it's going to be there. And so taking vacancy risk, taking development risk it might not be the right time.
Sure.
And I think that we feel optimistic that we're getting to the point where it is the right time.
Yeah.
And the demand is here, and the cost problem that Southern California had for a long time is not as stark as it once was. So I don't know. I'm optimistic. I think that talking to people like you every day that have the inside scoop from tenants, have the inside scoop from other landlords is really helpful in how we think about making decisions.
Well, that's also the purpose of this show. The purpose of this show is to kind of bring that inside scoop where I feel like is so valuable in our business, and you only have it if you're in the business.
Yeah.
Right. And hopefully this can be a medium where that gets to be shared on a larger scale.
Yeah.
Well, thank you so much for coming.
Yeah.
I
Thanks
really
for having
appreciate it.
me.
Yeah, it was
This
a
is
lot of
awesome.
fun. Yeah. And I wish you guys a very successful 2026, and hopefully we can do some business together.
Yeah, please.
Thank you so much. All right,
Thanks,
great.
Shai.
Thank you for listening to Adding Value with Shai Assar. We'll continue bringing on guests with stories and insights that matter in the world of industrial real estate. If you enjoyed today's episode, please share it with a friend or colleague. And if you're a landlord, tenant, or investor exploring opportunities in the Inland Empire, feel free to reach out to us. We'd be happy to help you navigate the market.